You're welcome back to Business Morning. We're now being joined on the program by research analyst with Meristem Securities, Jolomi Odongharu. Good morning, Jolomi.
Good morning.
Thank you for coming on the program.
Thank you for having me.
Meristem Securities actually forecasted that the central bank MPC would keep its rate on hold. Were you surprised that it actually changed gears?
Yes, we were. We expected the MPC to hold the rate, and we expected the focus to be on growth at the moment. But obviously, they decided to focus on price stability over growth, and at that point, that's why they did what they did. Well, we expected a hold.
Why did you expect a hold?
That's why if the focus is on growth and internal growth of that, then you would expect them to hold the rate at least or bring it down.
Okay. I know that at the time of the announcement yesterday, the markets would have closed, so we didn't get to see any reactions. But today, what do you think the impact on the fixed income market, the bonds and the treasury bills will be like?
Yes, expect when you change the benchmark interest rate, there's a direct and immediate impact on the market. So what we'd expect is that immediately today there'll be a repricing across the assets, so you see the yields on T-bills as well as bonds rise almost immediately. So we are expecting now T-bills rates, the discount rates on T-bills are already quite high, but we expect more of a reaction on the bonds. So the bonds have been trading about 15 to 15.5 to about 15.84 on the average. So we're expecting a hike maybe above 16% in the yield.
So the bearish sentiment in the market would be brought to a halt?
Yes.
More like?
Yeah.
Okay, if you look at the fact that at this point where this decision has been taken, people, like I was speaking to Silewa just before it left the show, and it was saying that it seems to be in favor of the banks, this decision, for those who play in the treasury bills market and the bonds market. Do you agree with that?
You can see it as it's favorable for the banks, but I wouldn't say only favorable for the banks. Now, if you look at the decision and the impact they're expecting, the MPC expects to have, you can see where they're trying to keep the prices stable and how they're expecting it to transmit to growth as well. But for the banks, obviously, from where we were at the start of the year, when revenues weren't expected to grow that much, then all of a sudden you have the FX impact on their books, as well as being able to invest in a higher yield environment, most definitely would affect the banks positively.
So should we expect more liquidity in that market?
Now, with liquidity per se, would expect liquidity levels are already quite low compared to where they were sometime in Q4 when they were about over 1 trillion naira liquidity. Now it's more in the region of about 300 billion. And FX market transactions have caused liquidity to come further down, like stated by the central bank governor yesterday. And with more attractive yields, what you might see is that liquidity comes further down as well, which would also impact the yield environment.
Okay, so we should expect more activities.
I would expect more activities,
at the market. And there is the concern that investors may actually shift away from the equities market to come into the treasury bills market. Of course, the short to medium term gains being the attraction. Yeah,
obviously, if you look at the fixed income market now, we yield in 16 to 17% versus equities markets where we're not expecting significant gains in the year. Maybe a marginally positive market performance by the end of the year. It's more attractive to shift to the equities market, to the fixed income markets over the short term.
Okay, today let's talk about how the markets would react. Are there particular instruments, both at the treasury bills and the bond market, that could be the most attractive for investors?
Right now, the treasury bills are quite attractive. The yield is in the range of about 16 to 17% discount rate. The yield is just around there as well. Right now, they're more attractive than the bonds. Now, we expect the reaction in the yields of the bonds going forward, but for now, the treasury bill yields, I mean, the shorter term is more attractive than the longer term bonds. We would expect more activities on the treasury bills at the moment.
Okay, thank you so much. That'll be all. Jolomi Odongharu, research analyst with Meristem Securities. We do appreciate your time with us
Thank you for coming
on the show.